make sure we have a decent sound check. That's the first thing we're going to do this morning, and see if we got a quality that's sufficient to your liking. So, first test is the sound quality decent here? And I guess for sound quality test, what we got to do is say testing, testing, testing. Good morning, fellow traders, members, friends, and I hope all is well. Okay, wonderful. All right, we're sure what we're a little light this morning, but that's okay. This is recorded, so a few things that we're going to discuss today. And I already noticed Bill McKee in the room posted to look at the Commitment of Traders report, and that's kind of funny because yesterday in our work last week, I kind of harped on and I want to cover that. So if you didn't, you can take advantage of downloading the weekly sheets here in the document tab. I always thought, and I always taught people, and just to start from top to bottom, I think it's important to go through this week's sheets. I always like to, anytime that I get in a very short period of time, to cover short option premium positions when they come near the 50-80% maximum profit target. Like, so if you sell like 2 weeks ago, like the Starbucks credit call spreads, and they come, you know, fairly close to 50-80% of maximum profit target, and things aren't really looking, you know, like it's going to crash, then get out. I mean, because you can only make so much. The mistake that a lot of option traders make is that they think they have to hold to expiration, and it's not the case whatsoever. And I've seen where people just say, well, they'll expire worthless anyway, what the heck, and then they come back and bite you in the behind, and that's generally when you least expect it. So anytime you're selling premium or you have short premium strategies, like, for example, a bear call spread or a bull put spread, otherwise known as vertical credit spreads, then, and I know there's a few other names for them that people have put on them, but those are the traditional names. But anytime that you sell premium, don't be looking to take the whole thing in, especially if it happens in a very short period of time. Anyway, last week was the stock market gave, as I say, plenty of opportunities for both bulls and bears, but it came with pretty scary risks. Every trade, day trades were, you know, interestingly enough, 4 weeks ago we had some pretty decent or incredible volatility. 2 weeks ago the volatility died. One of our members said, well, when do you expect volatility to come back? And I said, probably by midpoint of next week, which was last week, which I was off a couple days because it was the beginning of the week. So needless to say, we did get a very wild ride market, and whenever there's an opportunity for fantastic trading opportunities, so's the risk of loss, and I think that really needs to be disclosed. And if sometimes you're going to be day trading when your risk factor is too great based on the signal, one of the things that I like to mention is, hey, if you're going to hold something overnight, or if you would think that this could be a good swing trade, and it's at a level, instead of focusing on the day trade setup, which might be too much risk, then utilize some directional option strategies, you know, depending on your time horizon, shorter term, higher delta, longer term, and depending on the setup, like a high closed doji. We all know that within 2 bars, a high closed doji should show results, either higher highs, higher lows. So in a high closed doji pattern, for example, if we have a strong setup, you know, high closed doji, monthly support, pivot support, something like that, good strong volume behind it, we know that we have within the next 2 bars or 2 time periods. So if it's a daily chart, it's 2 days. If it's a weekly chart, it's 2 weeks. And then you can adjust your expiration, your option expiration accordingly. And your exit strategy, that's the beauty, your exit strategy can be adjusted accordingly. So by the 3rd bar, nothing moves. 4th bar, you can start saying, hey, this thing ain't moving. Time to, you know, get out. And then, you know, we'll move on to the next trade. Also, at the end of the week, we had Friday the 13th, and the markets did have that sense of gloom in the final hour. But then we started to see some short covering and a bounce off intraday lows. So remember, I always teach you guys, it's not how the market opens, it's how the market closes. All in all, on a year-to-date perspective, I just thought I'd put this in front of everybody. We're up less than 0.25% in the S&P 500, whereas the German DAX is up nearly 18%. Now, the euro's down about 13% year to date. So the German ETF, the EWG, and we have a listing both in TradeStation, and many of you see my, which we'll get to in a few minutes, my relative strength page on Genesis. And we can take a look at when last July 3rd, when the world was, everything pre-July 3rd was moving in tandem, in sync, trending together. The globe was. And then Janet Yellen said something, and we saw that major detachment. She said, changed a word, and the market was preparing on January 3rd for an eventual move. And we saw weakness in Europe and quantitative easing, and so that's the difference. But in any event, this week, what's the point in mentioning about the euro and about the German DAX and the U.S. market? Because the strength in the U.S. dollar has been a problem. It's becoming a bigger problem, and it may be a major problem for the Fed as they try to unwind from a quantitative easing environment to a normalized interest rate market. I like that, where I made this sound very smooth and eloquent. Normalized interest rate market means interest rates are going up, guys, right? So the kicker is, not only is it St. Patrick's Day, but this week is my birthday. I'm not letting out which day, but this week is my birthday. It's also quadruple witching expiration on Friday. But the FOMC has a meeting this week, and Janet Yellen has a press conference this week. So I think the world, including myself, will be listening very intensely. So last week I stated that sectors entering seasonal strength, such as energy refiners, production companies, may continue to make money, even if the oil prices decline, right? What we need to see is, yeah, we know there's a huge buildup in crude oil inventories, but what we never see is what the demand. And people are believing that demand abroad because of Brent prices is declining. But I do believe this will be it's kind of hard to imagine with airlines, with the transportation sector benefiting from lower energy and looking at consumers with more jobs, that how we could see demand domestically decrease. It doesn't look that way. So I'm still thinking that we're going to see strength come in some of those energy refiner and production companies. Anyway, home sales, I said last week, may bump up if enough people meet the financial requirements, which is why I think retail sales hasn't done great in certain areas, because people are saving money. Anyway, two names in the builder sector have earnings this week. It's D.H. Horton, KB Homes. They come out on Friday. We should be listening to what they have to say. And that might give us a clue as to what, if they had pre-orders, if they have down deposits, if they're not looking at what building was in the past, but what their guidance is going forward. That's my interest. I don't care about how many homes were built in Chicago in January. I know the answer. It's tough to break ground when it's 40 below wind chill factor. I guess you can use dynamite, but the ground's so hard, they do have these kind of cranes. They can do anything they want, but typically, who in their right mind wants to go out searching for a house anyway in 40 below? So I want to see what's happening, as last year, as a reminder in this trading room, we mentioned that there was an increase in apartment lease agreements, and there was an increase in people renting apartments. And one of the main reasons is because they did not meet financial requirements or did not have enough down payment. So they went into apartments. When those expire, coming in April through June, I think we're going to see an uptick in building and the housing market. Now, as for the strength of the dollar as it relates to the euro, a couple things that I see down here. I mentioned to you guys last week when I was in California that I heard foreign exporters, it was a food conference, and they were saying they were going to stop all orders. They weren't going, and they were needing to raise their prices. Another thing is very interesting. Down here in South Florida, I'm sure many of you heard the news since 2009. What really helped buoy both the Vegas market, a lot of the distressed areas, Southern California market, as well as the Florida market, were foreign investors due to the weakening dollar. So we got Canadians, Brazilians, we've got Europeans, and they're all in the South Florida market as well as maybe the Vegas market. So if the dollar goes way too far, and even though investors may have put a big down on a house, or let's say paid cash for the house, they still need to maintain the house, pay the taxes, pay the maintenance fees, pay the electricity fee, pay the bug guy, pay the pool guy. They still have to pay all these things, and if they are based in a foreign country, they have to convert their currency to dollars, and they're losing hard. I think you're going to see maybe an effect in the real estate market temporarily, and that will also be very good for U.S. domestic buyers. So here's the kicker. Is that going to help or hurt the builders, number one, and how much is this going to really, open up more properties that are being leased on the market? Remember, a lot of people in the real estate market, they bought properties and they rent them out. Well, they still can't cover their expenses. This is the thought process that I'm just thinking of. And I'm starting to hear a lot of people mumble and put their properties, their second and third homes, on the market and for rent, by the way. And so this might be something that we need to really keep and continue to listen to. So that dollar, and I think the Fed is very aware of what the heck is going on. So, any event, I said last week that I said I could see the FXE experience a 1 to 2% pop near the 110 in the near term, 30 days. Well, that's going to now need to see the FXE based on last week's decline, not a 2% move. We're going to need a 6% move in order for that to occur, since the dollar continued to strengthen all last week right into Friday's close. But it was due to light volume, the Fed's meeting, along with a seasonal turn and quadrilateral witching, and I'm going to talk about this in a minute. Friday, I kind of announced in the room that I was buying some of these FXE, and I would suggest that if you want, they're a 33 delta, the June 106 calls. We know that in the next couple weeks, especially if it's an event this week, we have something out there that could cause a short-term squeeze to the upside in the euro. All right? I'm not holding those to the end of the world, and if the dollar continues to strengthen and the FXE continues to go down, it's a 33 delta. I'm not going to get crushed in a loss, but if the market moves up quickly, fast, it's going to springboard. That 33 delta is going to change to a 50-60 delta in a heartbeat. And so if you can imagine, if you get a 30 delta that turns 60 delta, you're going to double your money. So I love that play in this time frame. All right, it is. I guess in the condition bottom picking, but bottom picking, I just want to point out to you, the COT data shows hedge funds in an enormously huge net short position, like let's say 4 to 1. So as we get closer to the end of the quarter, and what makes a hedge fund work? Well, they take profits on a quarterly basis, and I believe we are susceptible for a nice short covering profit taking correction, and perhaps Janet Yellen. And all it would take would be the Fed to alter a word or mention they are not raising rates soon, and perhaps they're concerned that global economic growth and deflation are a problem. If they mention anything like that, what that means is the dollar's too strong. So, as for the U.S. stock markets, I'm not going to rule out for a potential rebound this week. I believe we are going to see one, but we may see, and I thought we would see a lighter decline first. So, overnight, last night, we did see the market open up a little bit lower. Right now, it's trading sharply higher, like 14 handles higher. And why do I say this? Is because the CFTC report showed that small speculators, and I capitalized that. I should have capitalized it. I should have bolded it. I should have underlined it. 143 new net long positions or 143 new long positions as of Tuesday's close. So what we're going to do is we're going to examine what the difference is of what happened from the prior Tuesday to this Tuesday. Remember, the report's from Tuesday to Tuesday, but as of the close Tuesday, it's a 3-day hang time. It's released on Friday. So we need to look at what did the markets do between Tuesday's close and the prior Tuesday when the data was collected or extrapolated. The hedge funds and commercials added to their short positions. So I would say, since when are the small speculators right against those two groups? And so the key is, did Friday's rally off the low, was that getting the speculators, when it went down, did the specs get pumped out of the market on their longs on Friday? as the market made newer lows into the weekend, and then in the final hour, did the hedge funds come in and buy and cover their shorts? And that, my friends, is I think what might have happened, especially since we opened a little bit lower overnight. So a couple things that I want to point out is, last week I told you that we had 78 stocks were only above in the S&P 500, their 10-day moving average. So with a weakening market, we had gone from 78 stocks to now only 130 stocks, which means the market was buying into the dip last week. The daily McClellan oscillator is at negative 134. The weekly reading is negative 204, and that suggests we're into major oversold market conditions, and I'll get into that in a few minutes. The IWM looks the strongest, not only with breadth, but it's also in a weekly buy mode. All the other stock indices are in a weekly sell mode. We were focusing in the IWM. We were focusing in on the Russell being the strongest, even from Thursday's analysis with TradeStation Thursday. And I still suggest that, as I said, S&P support area, we're still in that support zone, 2060.48. This is based off the March contract, which is rollover. It expires this week. If we close continuously below that level in this week, then I am going to change from bull to bear, because if a close on Friday gets us underneath that support level, then we're looking 2015 to 1980. All right? Anyway, some bullish stocks to watch. We mentioned Green Mountain Coffee Roasters. The earnings are 5.5. Bed Bath & Beyond, we still want to watch those. Carnival Cruise Lines, and even Ford, which we have earnings, so we're going to be looking for that. I found I couldn't find the earnings for Leucadia Financials. Bank of New York, Mellon, NBTV, excuse me, Consumer Staples, still like Mondelez, I think in the food sector, seasonally that looks good. Energy, believe it or not, Cabot, oil and gas, still looks healthy. Biotech, this has not been working for me, but I can tell you that the biotech market is still susceptible going into the end of the quarter as peaking out. Materials, Sherwin-Williams. I just didn't want to say, hey, I posted this and that's it, and neither here nor there. But as far as retail is concerned, look at these names. Nike, which has earnings this week, Delphi Automotive Parts, and then Amazon, believe it or not. Every one of these have bearish divergence in volume. Every single one of these had weekly low closed dojis, and I wanted to make sure that my folks in the room knew about that and we could see that. We have no real new trades for seasonal spreads, but we still are looking at these trades that are good to go into May. So dips as the hog cattle spread, which we've talked about and we've gone over, we're waiting to see a new higher high, higher low, but that spread, which we backed off, not buying, namely on the face of the fact that it got bid up a week before we were supposed to buy it, and then it came tumbling down. But it's a wild mover, and I'm still interested in this. I'm tracking it. I'm stalking that one like there's no tomorrow. So today we have had the Empire Survey out, housing index. Now we have Australia, minutes to the last FOMC meeting in Australia. That comes out at 8:30 tonight. I want everyone to make sure they knew what that was. AU is Australia. Royal Bank of Australia comes out with their minutes of their FOMC. I think that's kind of important since this is a joint concerted global market environment. UK, they come out with, Britain comes out with their last quote-unquote Fed meeting. And then I don't think any of that makes a real bit of difference until probably the 2 p.m. FOMC announcement on Wednesday, and of course the press conference, and then the Fed's forecast, which Janet Yellen's going to be asked a bazillion questions at 2:30. After that, then there really isn't much. Fed speaks. I don't even mention their names because it's not really important to me after Janet Yellen. You know what I mean? They can say what they want, but I don't think it's as important. I think that the Philadelphia Fed survey leading indicators will be important. Note that we have an announcement on the size of a note auction. No big deal. And then most importantly, Thursday is the last day to trade options, and then Friday on the open, everything's assigned to value. As far as earnings are concerned, really they're, as I mentioned earlier, Nike on Thursday, FedEx on Wednesdays. We have Williams-Sonoma, Cintas, and of course Adobe after the close on St. Patrick's Day. So sometimes in the old days, green beer would be served with corned beef sandwiches at the Board of Trade, just to go through a history lesson for you. St. Patrick's Day in the old days, and I'm talking my day in the 80s, was not a very heavily traded day. I'm here to tell you, the Board of Trade was about 90% Irish Catholic. I mean, if you think about some of the guys that started there, the Geldermans, the O'Connors, the O'Briens, Mr. Brennan, I mean, the list goes on and on and on and on. The old grain guys, the Irish Catholic kind of consortium. This was one big drunk fest, and on the floor, when the grains closed, you couldn't get into a bar unless you were somebody. Now, I think things have changed because in the last 30-plus years, it's more apropos for people to say they've been to treatment rather than they're diehard drunks. Anyway, that's just my joking take. I hear that a lot on TV now. So anyway, I wanted to cover what I mean by this week's weekly thoughts, and I want to get into a couple items. Namely, I want you guys to take a look at our AD lines and where we stand with the advanced decline levels, even with last week on a daily basis, right? Seasonality is very strong this week to go up in the S&Ps. Looking at the market here now, if you take a gander of this market, remember there's about, and this represents here the March contract, and then it flipped over into June. You see, if you look up here, you'll see every time I scroll over, it says 2015 03, 03, 03, 03, 03, 03, 03, 03, 03, and bang, right here, that was inserted with 06, so that's a continuation contract. Let's take a look at something different. And most traders and charters and beginners, this is what they would get on almost every software. So let's take a look at the ES, and let's make it just the S&P. And this is another great example of when we want to look at either comparing an apple to an apple or look at the cash market. So why am I doing this? Because I'm going to tell you why in a second. For us to figure out potentially where the small specs and what happened to them is, right? So let's take a look at this. So this is the current market that we were more used to in our minds trading. And then when you look at it, it's 2062.5. Now this is the, guess what? It's still trading. It's not as, it's getting thinner, so we definitely want to roll into March contract. Don't get me wrong. But needless to say, Friday, Thursday, Wednesday, Tuesday. Then, if you think about it, if that's Tuesday, Monday, then this was Friday, Thursday, Wednesday, Tuesday. So, in the report that I'm about to show you, from Tuesday's close, that left Wednesday, Thursday, Friday, and Monday. Somewhere in this level, somewhere in this range, the small speculators, all the way down here to Tuesday's close, somewhere in that level, somewhere in here, the small speculators added to their long positions. Now, their long positions, on average, were about right at this level, which we've discussed in prior Mondays. And as I told you, commodities are like potato chips. No one ever eats but just one. So at what point did the speculators add? Did they add here, here, or here? I'm not going to say they bought and added to the high. That didn't make sense. but they probably added when the market gave a little breath of hope, somewhere around 2077, and probably held on into the close. All right? So then they had to roll out of the March and get into the June contract. And if they didn't, we opened a little bit lower. We had this huge move Friday or Thursday to the upside, and then Friday it started to get ugly. So with that said, did the small speculators, were they capable of averaging a position and holding on a combined amount of approximately $5 grand? And I don't think so. I think maybe perhaps they got a little underwater on that trade. But here's what we need to look at, and this is the S&P 500, and this is based off of course, the weekly chart. This is a this is the March contract since its inception. So now what I need to do is change this. And I want to put back to the continuation contract. Here's what I wanted to share with you. On a weekly basis, the hedge funds went mildly short. That's not a huge short position like down here. All right? And the public added longs. And I've rarely seen them hold on and be right. So my guess is, and this is what I said to you last week, it's not going to be this Friday's report that's going to be the true reflection. It's going to be next Friday's report. Because remember, a lot happened Wednesday, Thursday, Friday. And I think the market, they kind of got blown up a little bit. All right? Looking at the weekly AD lines. The weekly AD lines, interestingly enough, did you not notice that last week, of course, if you note here, this is from Friday. We had a lower market in the ES. Which direction is the advanced decline pointing? So we actually had an uptick in the advanced decline. Commercials, or I wouldn't say this does not represent speculators as much as maybe institutions in buying stock, but the advanced decline actually upticked. So my premise is that I'm a little bit less negative on the market. And again, on the Russell here, while we did have, and we got to change this a little bit and look at the cash market. But boy, I'll tell you what, guys, that advanced decline was very special. The volume still held up decently. And for any of you that followed our lead last week on the IWM, which I know Ed L said which ones were they, and might have taken a little bit of pressure, but on Friday, man, that was what we would call on a week-to-week basis, that equal and opposite, and it never closed below the line. Look at the week-to-week advanced decline analysis, and that we're in a very nice, strong seasonal upturn, and the volume looked pretty healthy still. All right, it's still above its moving averages. So, needless to say, I'm still bullish on the Russell. This week could be very important, and if we get any further upside in the Russell, in the IWM, and you have a nice profit before Janet Yellen starts talking, I would strongly recommend take something off the table. Okay? As far as looking at the euro, and I might have, what's the word I'm looking for? I think at this point in time, stalking a market and going with a low risk, and I say lightly, I mean like less than a couple handfuls. I mean lightly on the FXE, because you know I'm going over to Paris, and I don't in 2 weeks, and I just sense that something's going to change dramatically, a dead cat bounce here, especially since the funds are so long, or excuse me, short the euro. So if I may point out, here's the funds short. The commercials didn't add. Now, if the market was going to continue to melt down. If the market was going to continue to melt down, you would note that the commercials would add to their longs. And as we've seen, the commercials are not adding to their longs. In fact, they're starting to unwind it looks like we're starting to unwind the longs a little bit. All right? So this chart to me suggests I don't think it's going to get our next new last conditional change on a weekly basis. I'm only looking for the market. I think we could get back to like 108. We change this to a daily chart. What did 108 represent? From a monthly and a weekly perspective, monthly analysis is out the window. Option expiration kind of out the window. But I mean, on looking at the euro, you know, I would say even looking at the daily chart, Friday's action was very light. A move minimum objective back to where we were maybe a week ago, 108, something like that. All right, so a 3% move in the euro. If we get that on the heels of Janet Yellen, I think, you know, that might be, we go from a strong trend market condition and we bounce off of the lows a little bit, forming a little shadow, and then we'll see what happens as it transpires. I'm not saying this thing's going to rip and roar, but I think that as we get near this zone of the buck, it's for me worthy, especially seeing the hedge funds and how they operate, and look for a little profit-taking correction. That's about it. Then we'll see what happens from there. All right. Apart from that, I do not expect volatility to change this week, and I expect more huge moves, which I think after Janet Yellen, we're going to see the lineup in consumer discretionary stocks change, as well as utilities. And so those are some of the things that I'm watching for from position trading. And as far as day trading, we'll continue to mark up the charts as we start the rest of the day. So with that said, that does planning and scanning. And with that, I will stop the recorder and switch screens.